In this session, we are going to deal with the basic introduction to the world of equity valuation, along with what are the various needs for which we do equity valuations, and what are the various methods that are available to do the equity valuation. So this is purely a non-numerical kind of a coverage, wherein we are purely looking from the process perspective as well as the basic understanding of the world of equity valuation. Whenever I talk about equity valuation, a valuation is a very interesting word which talks about identifying the value of equity or identifying the true value of equity, or what is the real worth of that particular equity. That is what is the definition of valuation. Finding out the true value. There are various mechanisms to find out the true value of the equity security, and that is what we are going to look at as a part of this session. So whenever we talk about the various valuation things with respect to any equity, we are coming up with a process saying, okay, when I talk about equity valuation, I am saying what is the worth of this company, what is the worth of this equity investment, what is the worth of the share if at all I have to purchase one. So what we do for that is you understand the business. What is the business in which the company is operating? So based on how you understand their business, you do some predictions about how the company will perform in the future. And based on that, you choose an appropriate valuation model, and using that model, try to arrive at a value. And once you arrive at the value, probably you can make your decision in terms of buy, sell, hold, or any such kind of decision. So before we understand a little bit more into it, a few more definitions that are worth understanding here are, we always use a word called intrinsic value. Intrinsic, otherwise called as true value or probably inherent value, right? What it is if I know complete details about that particular company, complete characteristics of that investment, based on that I give some value to it. This is worth something. We do it in a regular day-to-day world also. Let's say I want to buy a television. There are different ways of finding out the value of that television. Understanding the various components of that particular television, what are the kind of benefits that they can generate, how long will that particular television have non-repairs, to what extent it can give me a satisfaction, what other costs I can save once I buy a television. There are so many things I can very well look at, and based on the entire characteristics and the cash flow savings associated with that particular product, savings or extra returns associated with that particular product, if I am able to find out how much is it worth spending for that, we are calling that as an intrinsic value, inherent value, the real value of that security. So I am not doing any comparison with competitors or anything there. I am going in depth into the understanding the characteristics of that particular investment, and what is the kind of benefit or cost saving that particular investment is going to provide to me. Based on that, I am arriving at one value to that particular investment. That is what we call as the intrinsic value. Now, every analyst has a different perspective of looking at the characteristics of a particular product. So every analyst generally comes out with a different intrinsic value. So whenever it is not the same as the market price. See, television, I may perceive that it is worth 40,000 bucks. Whereas someone else may perceive, yeah, 50,000 is also good enough for this. Whereas someone else may say, no, with this kind of features, 30,000 itself is more for this product. That is what we are calling as intrinsic value. So different analysts, different interpreting people perceive the price of that particular product differently based on the understanding, the level of understanding they develop about that particular investment or about that particular asset or security. That is what we say the intrinsic value differs from analyst to analyst, and whereas the concept of this intrinsic value is really good for a security which is traded very much publicly. Whereas on the other side, we are talking about another definition called market price, which is the price at which it is available in the market. It may or may not be the same as intrinsic value. Sometimes it may be very much higher than the intrinsic value. Then probably I may say it is overvalued or overpriced. In some cases, it may be much lesser than the intrinsic value. In that case, I may call it as underpriced. So market price is the price, one single price at which any particular product is available in the market. Depending on how the analyst processes it, if the analyst has if all analysts have processed the information in the same way, then obviously the market price may be the same as intrinsic value, but different people process information in a different manner. That is what we are calling as informational inefficiency exists, and because of that different people have different intrinsic values. So some people go for a buy, some people go for a sell based on the intrinsic value they are planning for, and because of that the market price is different from the perceived intrinsic value. So that's where we say, when I say analyst mispricing, which is nothing but intrinsic value as given by the analyst minus the actual price, that is the mispricing which the analyst has actually done. That is a component of two things. One, a valuation error. Whatever the intrinsic value the analyst has provided minus what is the actual intrinsic value, minus the actual intrinsic value. And here probably I am looking at the actual mispricing, which is nothing but the actual the intrinsic value which is actual minus the price. So it's a component. When I am talking about analyst mispricing, I have to really see whether actually there is a mispricing or is it because of the valuation error, and how much of the mispricing of the analyst is contributed by which of these components. So these are some of the things we have to consider before getting into any kind of valuation process. And when we talk about the word value, there are multiple definitions associated with the value. Sometimes we use definitions like going concern, which in most of the cases the assumption is the company operates the business forever. It does not get out of the business in this 1 year or in the next 1 year or so. So we are assuming that the company's operations are going to continue further and if possible for eternity, and that is called as a going concern value. So we always do the valuation of equity or valuation of a security based on the going concern assumption to a large extent. But if I really feel no, this company doesn't have any scope for continuing the business, so no scope for revenues or expenses over the next few years, if at all that is the kind of thought process that is there, then I cannot use a going concern assumption to typically value that security. So in that case, I would prefer going for a liquidation value kind of a mechanism, wherein I assume that the company is going to wind up in the next 1 year. So because if it is going to wind up, I will try to sell off all its assets separately, use the proceeds to pay off the necessary liabilities, and whatever the net that is left, that is what I call as the value of that particular security or asset. So that is what is called as a liquidation value, because I am not expecting the assets to generate any kind of income in future, because these assets are literally useless in future. Whereas when it comes to liquidation, when it comes to going concern value, I expect that the assets are put to use. They will generate revenues and profits in future, and based on that the value is determined accordingly. Then the other definition of value which people look at is the fair market value, which is more like, if at all there is a well informed buyer, he may be a real buyer or he may be a hypothetical buyer, a well informed and able buyer with all kinds of information, what is the price he is willing to pay to a similar kind of a seller. That is called as a fair market value. May or may not be the same as market value. When I say market value or market price, to a large extent the fair market value should be equal to the market price if the market perceives a very good demand and supply for this particular asset or the security that is being dealt with. And the other definition that we are looking at is the investment value, which is purely looked at from a buyer's standpoint. How much is it worth spending for this? Sometimes the buyer may look at the expectations or probably synergies, especially in case of acquisitions and all. Would it be a good fit to my business? Would it add any additional value to my business? So is it okay if I spend some more premium in terms of purchasing this, because it may add a value which is much more than the excess cost which I am spending on it. That kind of a value that I am giving to that security is what is called as investment value. And generally in case of acquisitions, the investment value is used more heavily than the intrinsic value. If the focus is acquisition, probably investment value is a much better tool or definition of value. But if I am talking about buying a stock, buying a share, then probably intrinsic value is much more a better definition of the value. So depending on the purpose, whether my purpose of valuation is for acquisition or stock purchase or what, depending on the purpose of valuation, I will choose the appropriate value and do the computations accordingly. And when I talk about equity valuation, there are various models that are associated with the equity valuation. One group of models are called as absolute valuation models, wherein I try to observe all the factors that can influence the value of the security, understand them, and make some projections about each of those variables. Based on those things, assess what is the worth of that particular equity security, where we end up computing the intrinsic value based on the benefits that I can expect from this investment in future. So typically we use a discounted cash flow kind of models. Present value of the future cash flows, we discount them at a particular rate of return and try to compute the intrinsic value of that security. Here we are trying to understand the characteristics of the firm to a large extent, the benefits that can come out because of this investment to a large extent, and use that information to find out what should be the value of this particular security. Here we are not making any comparisons to some other firms. Is it more price compared to the competitor, less price compared to the competitors? No such comparison. Just trying to identify the real worth of that particular security based on the characteristics based on its performance and based on the cash flows that it can generate in future, based on the benefits that it can provide to the investor in future. Based on all these characteristics, a value is being arrived at, which is what we call as an absolute valuation. It's not in relation with anything else. So that kind of valuation model will deal in detail each of those valuation models, but just to have a broad category of the various types of valuation, we can very well say the absolute valuation model, where we end up finding out the intrinsic value without making any comparison to the other models, purely based on understanding the characteristics of that particular security, is one type of valuation. The other set of valuations come from comparisons. I don't try to see what are the investment characteristics of this particular security, but I try to identify firms which are more or less competitor to this particular security, and based on that see whether that competitor firm is priced more than the selected firm or less than the selected firm. Instead of directly looking at a number, I may look at some kind of a ratio, size adjusted or earnings adjusted or a book value adjusted, some such kind of a ratio I would be looking at. And on those ratio grounds, I would like to compare the performance of the two companies and say, if the competitors are all worth at this level, probably this company should be priced, the price of the share of this company should be slightly more or slightly less. The valuation by comparison with someone else, some other company, is what we call as relative valuation model. That's one more category of models we would be looking at for the valuation purpose. And the other set of models which we will look at is asset based. I just add up all the assets of the firm, whatever the assets are there from a market perspective, what is the value of all the assets which the firm is having, and then say this is the total value of the firm. Generally, we use this kind of model for those companies who own or control the natural resources like mineral fields, oil fields, these kind of natural resources whichever are being controlled for those companies, rather than going with absolute valuation or relative valuation models, we look at the asset based models. And coming to the users, people use equity valuation for a wide variety of purposes, as we have been talking about, for investment decisions, for buy, sell, hold securities. We can look at the equity valuation model. For assessing how much should be paid for some kind of corporate restructuring activities or corporate actions like mergers and acquisitions or divestitures or any of these kind of activities, finding out what should be the price that needs to be paid or received for any of these corporate restructuring activities, we do use the valuation mechanisms. To give fairness opinions in terms of minority interests and legal assessments and various other things associated with the value, or probably to represent the value of a pension or to represent the value of a lease liability and various other aspects that needs to go as a part of fair market value representation, as a part of various standards. We are using the valuation model. Probably I use the same model to do the valuation of private businesses, not just the public listed companies. Even I can use with small modifications of the public companies, I can use the model for valuing private businesses. Then it becomes an important tool as a part of portfolio management process in terms of planning which sector to choose, which companies in the sector to choose as a part of my portfolio. I'll do a valuation process to identify the securities that need to be included in the portfolio. And this valuation is a kind of a common platform which helps people to discuss about whether we have performed well compared to the competitors, or whether we are overpriced in the market or underpriced, whether we are recognized to the extent of our performance, or we are under recognized, what such kind of thing is existing as a part of our security or company can be derived by getting into the various equity valuation mechanisms. And whenever we are doing any kind of equity valuation, we generally get into an understanding of the industry as well as company analysis. These two things are done in detail before finding out the valuation part. So from an industry standpoint, we go with the Porter 5 forces model, which talks about, okay, for each industry which I am looking at, identify, okay, what is the threat of new entrants. Is it very easy to enter into the industry, or are there any kind of barriers to entry? Right, if there are high barriers to entry, probably the industry can grow only to a certain extent. Similarly, how good are the substitutable products for this particular industry? What is the bargaining power of the customers as well as the suppliers? And what kind of competition that is existing? These are the 5-dimensional stuff which can tell me what kind of profitability that can exist in the industry in the long run. So every analyst should focus on the industry power, the industry structure based on this 5 forces model, and evaluate what is the kind of long-term profitability that is associated with the industry. Because if in case he is making a conclusion that this industry is profitable, then within that industry he can look at choosing some firms which have demonstrated either some kind of cost leadership, which are able to operate at the lowest cost compared to their competitors, or have done some kind of product differentiation in terms of products or services or anything else, where they are able to charge a higher premium in terms of the price, but still they are able to generate their revenues quite comfortably because their products are slightly different compared to their competitors. And also identify whether there are companies which have a focus, means in some areas they are demonstrating, in some business segments they are demonstrating either a cost leadership strategy or a product differentiation strategy, or both. And at the same time, there is a lot for doing an equity valuation. So once you have assessed this particular industry is profitable, and based on that you have shortlisted on a list of companies which are falling into any one of these categories, then our intention is to do the equity valuation by applying an appropriate model. And when I am doing an equity valuation, majority of the information will come from my financial statements itself. And so assessing the quality of the financial statements is very essential in this perspective. So we have earlier we have discussed in what ways we can assess the quality of the financial statements, or what are the various locations where the management can tamper with the financial statements. So by understanding and what are the various tools that are available for us to talk about the quality of the financial statements. So all these things put together will take a shape into the valuation of a particular company. Apart from this, especially if that company is operating as a conglomerate, we also look at doing a valuation using the methodology called sum of the parts, wherein, okay, if it is into 5 businesses, if a particular company is a conglomerate operating in 5 businesses, I will find out the value of each of the business separately using, let's say, an absolute valuation or a relative valuation or any of those mechanisms. The sum of all these five values is the total value of this particular conglomerate firm. Whereas in reality, what we see is the actual market price for this will be lesser than the sum of the parts, and that decrease, whatever is the difference between the sum of the parts value and the market price, is what we call as conglomerate discount. In most of the cases of conglomerates, we see that the sum of the parts is much lesser than the total. Sum of the parts is much higher than the total market value. Individually, if I find their values separately, and as well as look at the overall market value, we see that the sum of the parts value is much higher compared to the market price. The reason that is being looked at is from a management standpoint, because there are different businesses, the capital allocation in general has to happen for the highest successful kind of a business or for highest successful kind of projects. But in this case, what could happen is, because they have multiple businesses which are operating, at least some amount of minimum capital will be allocated to each of these businesses, which means overall allocational efficiency may not come up in the process. So because of that, the market may not give a value which is equal to sum of the parts. It may have to give a value which is slightly lesser than that itself. So from that reason, we see that in a conglomerate discount to a large extent exists, which is by the extent of the difference between the sum of the parts value and the market price. Sometimes it is also perceived that companies are just getting into the multiple business lines to cover their operating performances in one or two areas. If they have generated a poor performance in a year, probably a quick acquisition of some other unrelated company may show a better performance overall. So sometimes, because of this kind of non-synergetic kind of acquisitions, it may so happen that the market ends up giving a slightly lesser value to the combined entity rather than the individual entities added up together. And in some cases, it is nothing to do with the discount. It's the measurement of each of them separately or measurement of a combined entity which is a problem. So because of just calculation things or measurement related things, we see this kind of discrepancies existing. And how do you choose what kind of mechanism? Do I need to use absolute valuation model or a relative or sum of the parts or asset based? What kind of valuation model do I need to use? How do I choose among that? Whatever the model I am looking at, look at the characteristics. Is this model suitable to the characteristics of the selected company? For example, if the company is not giving any dividends at all, probably a dividend based model may not be an appropriate thing at all. Like that, let's say look at the model suitability for the purpose of the analysis. I need to understand whether I am doing this valuation for an acquisition perspective or for buying a share. If I am looking at it from an acquisition standpoint, probably cash flow based valuation models are more appropriate. But if I am doing a purchase of couple of shares, a dividend based model may be more appropriate. So various valuation models, even from the purpose of analysis I am looking at, the model which I have to use for valuation will completely differ. And the appropriate model, the usage of an appropriate model depends on the quality of the available input data. Let's say if my financial statements are completely tampered or are of not much of a quality at all. So the quality of the financial statement, let's say, is much more poorer. In that case, probably any valuation model which is based on the financial statements like absolute valuation model may not be of a much use at all. In that case, probably depending on a relative valuation model is much more appropriate, or probably asset based valuation model is more appropriate rather than using an absolute kind of valuation model. So depending on what is the quality of the data that is available, we have to choose an appropriate valuation method. And in most of the cases, people don't just restrict themselves to one single method. They can use multiple models so that a proper verification happens. And based on the assumptions, each model may result in a different value, but at least they should be in a slightly closer kind of a region. If there is a high discrepancy that is coming in the value of the various models, there is something serious that has gone in, which will make the analyst to think a little bit more, do some more research and arrive at the value of that particular equity. So in a nutshell, this session is focusing more and more, has focused more and more in terms of the basic understanding of the equity valuation, the various approaches that are there, like kind of acting as an introductory session. As we move further, we would be looking at the various approaches to do the valuation. We'll take up numericals to typically find out how I actually do a valuation of the company based on the various models and all. So just to understand all that aspects of equity valuation, this basic introductory session has been conducted. I hope you got a fair amount of understanding into this particular process. If you have any further queries regarding the same, you can get back to me by giving me a call on the number that I have given below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.